Good morning. It's Monday. It's the month of April. And yeah, we're going to do a video today consisting of gold and gold type of assets. So it's going to be a little bit, well, it's all freestyle in my world here. So I want to cover gold and the different types of gold. I've created a rough skeleton of what I want to cover here, but there's a couple different assets and I'm going to try to cover as much as I can. So looking at a little Microsoft Word document I briefly prepared here. We're going to look at gold. We're going to look at gold ETFs. We're going to look at gold mining companies. We're going to look at gold streaming companies. And we're also going to look at gold futures. And if you're deciding to invest in gold, this is a possibility of a diversification within a singular asset. So instead of, let's say, just buying pure physical gold bullion or investing into a gold ETF or investing into a gold mining company or streaming or playing in the futures market, how much of your wealth do you want to allocate to either one of these categories within just the broader category of gold? So looking at this, a lot of people are starting to look at gold more recently. Just gonna see if I can pull up some different things. So just looking on Google Trends here, we can type in gold, and we can see that I definitely had a little bit of a, I got it on the worldwide here, past 90 days, and we definitely had a little bit of a spike up in Google Trends here. So we definitely have seen some interest in gold, and it looks like it's kind of subsequently kind of rolled off here. You can look per region, etc., etc. You can just do within America, within a particular country. You can look at all these. So gold had a little bit of an upswing here, then had a little bit of die down. If we look at gold ETF, it's a little bit more muddy. These are probably going to be a lot less common Google trends, but I figured I'd just pull this up here in terms of looking at trends overall. What is spiked up sometimes? So you can see, Bitcoin had a little bit of a spike in interest. Nothing sustainable though. Regardless, this Google trend can be a little bit of a kind of fun to see what you're looking at. So maybe we'll just go through some of these a little bit more in discussion sense before we look at the technicals. But this is a site that I kind of liked looking at, gold versus gold miners, and it talks about some of the differences between them. And this is a little chart here looking at the dollar versus gold and just seeing how much the gold has really gained value in comparison to the dollar. So I think right here 53.9 times over the last 100 years, so 97% increase in purchasing power retained by gold. So you can see historically gold has been a better place to put your money than just holding dollars itself. And this is some of the comparative data, comparing, gold versus gold mining. And I think this stuff should be something to look at. So here in the 1970s is a good example of how gold and gold miners perform during inflationary time periods. And I think this time period is upon us, right? Inflation is upon us. I just got my check. Well, I got my assurance that it would be coming today. So, Lyndon Johnson's government was escalating the war in Vietnam and increasing government-backed social benefits. So, what's going on? An increase in government-backed social benefits. What's happening now? The benefit rollout of COVID-19. So, here we go. This caused the U.S. government to run an ever-increasing budget deficit. Prior to 1971, the U.S. dollar, as the world's reserve currency, was tied to the gold bullion at $35 per ounce. As countries started to redeem their redeem their US dollars for physical gold, the amount of gold being delivered was unsustainable. And in 1971, they closed the gold window, eliminating the abilities of countries to exchange their dollars for gold. So that is a possibility, hey? Like that's a very more of a far out possibility, but it is. So I mean, one of the benefits for gold, we could say right here, is that you have your asset physically. that is also, it's a benefit, it's a blessing and a curse, right? But that's just the thing. When you hold, let's say, paper assets that should hold gold, just like the currency used to, right? There's not enough. There's not enough gold, right, per currency. Regardless, inflation spiked as the U.S. increased its sovereign debt load by funding unsustainable government outlays. So, more government programs, right? Increased its debt. And gold had a huge spike in its price to $850 per ounce by 1980. So, from $35 an ounce to $850. That's quite the good gain there, right? And what's preceding it? Well, some of the same stuff that's occurring right now. All right, gold adjusted to the changing environment and increased in price in relation to the faltering US dollar. So, gold can increase extreme amounts in price because of the reality is it's not becoming more valuable, the dollar is becoming less valuable, right? So in that sense, that's where gold can really protect you in that sense from inflation. So right here, it shows a little bit of that. The gold exchange rate, right here, you can obviously see it grew quite a bit versus the US CPI annual growth rate. Right here, we got a chart here comparing gold and homestake mining. So we could see that over the course of from 1971 to the 80s here, gold did outperform the mining in itself. So let's just look at, I mean, this is just up for general information. I mean, this kind of stuff I think is good to look at too. I don't do this as much because this is not my specialty, but when we're looking at comparing the different ways to invest in gold, I think it's worth looking at one. So gold miner risk. There's exploration risk. No gold or not enough gold will be discovered. There's feasible risk. A company may discover gold, but at the current prices, it's uneconomical to mine. Management risk. Mining companies face substantial upfront costs and ongoing operation costs. So these upfront costs can be helped by gold streaming. Pricing risk. As gold moves up and down, individual companies can experience positive leverage to price increases or go out of business if price falls too low. Geopolitical risk. Governments can become unstable, leading to unreasonable demands or confiscation of assets, increasing royalty fees. Financial risk. During bear markets, banks often refuse to finance operations because the share price of many of the companies is too low. Environmental risk. Mining companies often work in remote areas that are ecologically sensitive. So any of the, activists too, right? Stock market volatility. Mining shares often correlate with the broad-based equity markets during downturns in the financial market. So it's saying that this is just correlated with like the general trend of the market sell-off. Mining shares are extremely volatile and can lack liquidity. So we don't have enough people buying and selling these shares. So when someone decides to buy or to sell, it can really move it quick, right? Productivity and efficiency. Mining companies often face major engineering problems such as cave-in, hedging policies. Mining companies often lock in price agreements that end up destroying shareholder value when major changes in operating costs related to bullion increase. Jurisdictional risk. Uprisings, war, political upheaval, and disasters are all common problems that mining companies face when working around the world. All right, so I can just say here, we got risks, right? There's risks. There's definitely a risk, right? What are all these risks? Exploration risks, all these different types of risks here. I mean, I think that's becoming evident. I mean, there's a lot of risk that goes into mining. Gold bullion risk. The risk of losing physical gold is significant if not valued in a safe location. So when you hold an ounce of gold or something, I mean, you have to be wary that someone is just going to steal it from you. That's what they're asking, right? The value of gold is priced in relationship to fiat currencies. Supply and demand fundamentals. We believe that physical gold will soon be unattainable for the average person because it's simply too expensive and rare. And then we have future contracts bought and sold by institutions such as central bank, hedge funds, and banks adversely affect the price of gold because there's more paper gold than physical gold. right here, here's another. That is something that, I mean, is an inevitable kind of thing here, right? There's more paper gold than physical gold. So let's just put here what these actually are, right? Mm-hmm. Just gonna put these because this is gold, the physical, gold the ETF, gold the ETF, the paper gold. We have gold mining, which is more or less a company. Gold streaming, which is another company, basically an investment company. And we have gold futures, which I put casino or trading, because we'll get into that. But yeah. So looking at some more of this, the difference between physical gold and mining stocks and how they react within a proper diversified portfolio. So gold is the most negatively correlated asset class to traditional finance assets such as stocks and bonds. Physical bullion should be a significant part of the strategic long-term allocation within a portfolio, whereas mining stocks should be a small part of a tactical equity component during certain conditions. So it's saying here, gold should be a part of your portfolio regardless. And how much part of just like your overall portfolio? Well, that's for each person to judge, right? I mean, for me, not that you should mirror my decisions, but gold and silver are really the only assets I hold right now. I mean, besides some other things that maybe I'll open up to, but right now that's basically it. And the thing is, I have an ETF, which is something that, going through all this information makes me kind of wonder as well. But we'll see. So the mining stocks should be a small part of a tactical equity component during certain conditions. I wonder what they mean with certain conditions, because we might be in this this environment of the certain conditions too. Multiple studies show that a portion of physical gold held within an investment portfolio improves returns and reduces risk, whereas shares of gold mining companies increase the amount of risk. Increase the amount of risk within a portfolio and can negatively affect returns over a long run. So looking at this, I mean, this is showing basically people that had a 60-40 portfolio and the annualized return and some of the different returns here, gold versus gold miners. So 60% stocks, 40% bonds, and then this one went through a couple different types of portfolios here, So let's just continue on. You guys can look at that if you want. So this shows Canadian miners under and over, and it looks like the only period where gold stocks significantly outperformed gold bullion was during a stock bull market. So that makes sense in my eyes, because if you're let's say like gold ETFs like HUG and some of these other companies, like when the stocks are rallying, when the whole stock market's rallying, I mean these are the kind of things that people buy, right? I mean, it's easy. That's one of the things with like ETFs. I mean, easy to purchase, right? I mean, and easy to purchase lower amounts. So that's why some people get gold ETFs. You don't have to buy an ounce of gold. You can buy $100 of it, right? And that's some of the attractiveness of such a thing. But right here, it's basically saying that gold itself is outperforming these paper-backed things, right? Because realistically, how could the paper be better than the physical asset, right? And right here, it's just showing some of the performance of gold bullion, the TSX, and then this miner index. And you can see that, right here, gold itself usually does a lot better. And look at a 30% loss in this mining company, whereas you're getting 7.4% with gold itself. So Anyway, you can look at this tab if you want it. I think it was pretty. It had some good information. So I'm just gonna go out of that because that just talked a little bit about gold mining and some of the risk. Right, there's a lot of risk with gold mining. May not perform as well as bullion. So let's just look at the streaming business model. I think I pointed this out before, but the biggest thing that these streaming business models are, they're lending to gold mining companies because of all these fucking risks, right? Sorry about my French there. I think that's the first bomb I've dropped, but so there's a lot of risk, right? So with the cost and complexity of owning mines, streaming companies making these financial investments, they're not just lending to one company, they're lending to all these different mining companies, and that just increases their risk, or it can mitigate the risk too. It depends on how you look at it. But just looking at some of the risk of, let's say, the streaming business model before you go all in on gold streaming and versus bullion or versus ETFs or versus mining or futures, it's probably the best to think about streaming as finance companies that get paid in gold. Their investments are effectively a portfolio meant to provide current returns from active mines and future returns as developing projects bear fruit. Balancing these two factors is the management's main goal. So again, we're relying on management of this business, right? Which is more risk versus gold where there's no people involved, right? So looking at streamers as finance business. However, investors think about a streaming company as capital structure. Short-term debt to streaming deals. To permanently finance those deals, the streaming company will then issue stock. Oh, issuing stock. That's not good for stockholders. Usually not. Or sell longer-term debt. Stock sales can lead to shareholder dilution. Great. You know, that means that your money in here is going to be diluted for them to keep going, keep business afloat. If streaming deals don't live up to expectations, but something to keep an eye on, this can happen for any number of reasons. Mines simply not getting past the drawing board, or mines that don't produce gold at a rate initially expected. So I think I'm getting the idea here too, right? I mean, there's risk into investing into streaming companies. While streaming helps avoid many of the risks of mining, there's no gold coming out of the ground. There's nothing for a streaming company to buy. So, again, the streaming here. All right. So I'm going to just get out of that one here. And let's just look at some ETFs here. So gold ETFs are just one way investors can put money into gold market. It always has pros and cons, right? So there's two main types of gold ETFs. Some ETFs focus on the commodity aspects of gold, seeking to track the price changes of the metal itself. These ETFs typically get exposed to gold by either holding physical bullion themselves or by entering the futures contracts, right? So we're looking at the futures contract. Other gold ETFs invest in the companies that specialize in gold. These include both gold mining stocks, which direct the yellow metal from their mining assets, and gold streaming stocks, which provide finance to gold miners in exchange to the right for purchase a set amount of a mine's gold production at discount price. Sorry, I'm not reading too well this morning, so let's just bear in mind I got a little bit of congestion here. But the ETFs, another good thing to realize, in my opinion, the gold ETFs themselves can be more based in bullion or more based out of these two companies, the gold mining and the gold streaming. And also, it looks like they have the futures contracts here, right? Right here, gold mining and streaming companies don't always match moves in the price of gold. Sometimes they even move in the opposite direction, especially if the company-specific incident, like a mine accident or a worker strike, affects the miner's ability to produce gold, to invest in gold stocks, or the ETFs that own them. You have to be aware of this potential divergence. So, again, another thing saying that these don't necessarily mimic the price of gold, which we're all just thinking, by association. So I'm just going to delete out of this too. And here's some of the benefits again. So gold ETFs, they can put their money in the gold market without having to invest in the physical commodity. So if you don't have a physical place to hold this, right? It's a cheaper alternative than stock or bullion. They can get different assets. So it's just looking at some of the different benefits here. We've got a little bit of an exposure to futures. So in my mind, futures are something that you can basically bet the price of gold, right? So I could open up a future saying that I believe that the price of gold will be $2,000 an ounce, and I reserve that price to withdraw it from. So you can make a bet that the gold will be there, and if that's true, you can pull out that money. You can bet the opposite way too. It doesn't have to be up or down. So that's how it works. You can take long or short positions on future contracts. In the long position, the investors buy gold with the expectation that the price will rise. The investor is obligated to take deliver him the metal. So you're basically selling stuff for a future price, and you being Nostradamus in the moment can give you value with that, right? So that's how the futures work. So that's why I said it's more trading and casino. It's not so much casino, but it's trading, right? So it's you're basically predicting if you're longing or shorting, right? And for most of us, that's a little bit beyond like normal entry level trading. Okay, so we're just gonna get this off, and this is the ETF that I own, Horizon Gold ETF. So I try to get a little bit more of a indication of, okay, what does this hold, right? I mean, is this holding more mining companies or streaming companies? Is this more backed in gold bullion? What is the case? You know what? I didn't really uncover that, but something to keep in mind when you're looking at, let's say, the ETF of your choosing, right? I mean, what is it actually holding? This is something that I'll look in more personally myself. So I'm just going to exit out of here. So the one thing that we have to be aware of is that when you have an ETF, you don't necessarily own any gold. So that is kind of the unfortunate thing. Look at the disadvantage. When you're seeking to actually own a gold asset, you cannot do so through a gold ETF. You never actually own a gold bar, bullion, or coins. Gold ETFs consist of gold contracts and derivatives and can only be redeemed for cash, never gold itself. So you have to realize that you don't own any gold here, you don't own any gold here, you don't own any gold here, you don't own any gold here. You only own gold right here, right? And that's a little bit of a broad kind of sloppy comparison with all these different assets, but you could say, like, let's say that you had an example of, let's say, $10,000 to invest into gold, and let's say that you did want exposure to mining itself or gold streaming itself, you're ready to take these risks. Maybe you wanted to do something like, maybe you wanted to do 60% in gold itself, physical bullion. Maybe you want to do 20. Or maybe you want to do some other type of allocation of your money. For me, like I do have most of it actually within the ETF, which is kind of making me a little bit more concerned. But with gold itself, yeah, you have to hold it yourself, right? I don't have a Fort Knox here, and that's just some of the unfortunate thing about holding the actual value, right, or the actual asset, which is you're kind of seeing that it is kind of the best, right? It performs historically. Physical gold seems to perform historically the best out of all these assets. I mean, ETFs are basically printing paper, backing it for gold, right? But if there ever is a time when we say, hey, I want my gold, they're never going to have enough, right? They didn't have enough in 1970. They don't have enough now, right? So if you can get your hand on physical gold, you better believe this stuff is going to be very, very, very valuable. But now you have to hold it and keep it secret that you have such a valuable asset in your house, or wherever you chose to lock it up. That's where there's companies that you can pay to keep your assets there. But regardless, I think that this was worthwhile to go through, and sorry that I wasn't the most clear and concise going over it. But regardless, let's just back that out and let's just go right to the charts now, because this might get a little bit long. So we're going to just look at gold itself. And here we got a strong buy. You can see there's a little bit of uptrend just with Google Analytics, and it had a little sharp decline right here. So just pull up the chart. So yeah, it looks like I have set up this chart for sure, and this was me looking at some of these retracement, some of these downturns, seeing if I could do a count with what's going on. I'm not sure if all these are perfectly correct, but do you see what I'm seeing here, guys? Do you see what I'm seeing? There's a big old cup forming here, hey? So I've been bullish on here for a while. I made my investments in gold, I don't know, somewhere in here. Once I seen kind of a flattening here, I was pretty happy about what I was seeing. So right here again, you could say what was formed, a cup, right? We broke past the cup. Would we have a bull run? What's coming? Well, if you're watching this on gold, I imagine you have the same premonition that this might be happening. So now it's just a matter of, do you want to make sure that you get this rise in gold price, right? What percentage did gold rise? What percent did gold go up by? Well, 650%. That's pretty good. That's not too bad. That's not too bad at all, especially for little risk, right? So if we could see something like a 3, 4, 5 times X in gold, I think that that's probably fair. I could definitely see all-time high of 1900 here. We could easily see $4,000 gold, within the next couple of years. I expected, how couldn't you have it? So now that we've had this kind of curve right here, we could just draw a couple different things. We could say right here we got the ceiling. We got the ceiling right now. What else we got? We got some type of a trend line coming up in the short term. Let's see what the long-term trend is. We draw something like so. these are just rough estimations, right? But yeah, I think you can clearly see we're forming something that looks pretty darn good, right? Especially in lieu of the current economic development. One thing that I could say, we could have a little bit, you never know how long this could be. You never really know how long this cup could form, right? We could easily do something like this before we come up. And that's just where, once you know that it will go up, it is showing a good trend here, it's going to be pretty tough. It's a matter of when, not, that's what it is. It's just a matter of when. So right here, we got up pretty high. We had our nice big crash down. And now we've just been kind of accumulating, right? And we've had a little good push right here lately, and that's what's accounted for this. It's seeming to round up a little bit. And just going off of how you should play breakouts, is that we wouldn't really want to see it just bust right up through like that. I'd much rather it just slowly accumulate up like this and then start to hover around this all-time high. And then you could really expect something wonderful from gold. But yeah, let's just look at this from a couple different standpoints. Grabbing this, let's just do a quick fib and see what it retraced to. So it hit about the 0.5. I didn't draw that perfectly, but you can see that it definitely is not retracing all the way back to the 0.16, the 0.618. My apologies. And we got some other good things here. We got some higher lows in gold, and we're getting some higher highs. So if we can continue this up, if we can just continue something like so, that's what I expect. A little bit of movement within here until we consolidate a little bit more, and then we're going to bust through here, and then see ya, man. See ya. But with gold, it's usually just not 2-3x overnight. It's a huge market cap, right? So that's something we have to consider when we're looking at just gold itself, because that means for this to move, right? For this to move, I was going to see if it had the market cap, but gold's got a high market cap. I think, well, let's just look that up. Around 9 trillion. Whatever, how accurate that is, I don't know. But if that's what it is, that means that for gold to double, it'd have to be worth 18 trillion. So it's a lot tougher for gold to have big moves, but you can almost be certain that, it'd be very, very, very unlikely, in my opinion, my personal opinion, that we ever see prices of $1,000 per ounce in gold again. I mean, it's probably not going to happen. Let's zoom this up to the weekly here. Get a little bit of an idea. So we're not really quite sure what's going on in gold right now. We're kind of just hovering right here. So it's not really too clear about what's going to happen right here, right now. It's going to check out the daily. Looks like we had a pretty good rise up here, but yeah, it's just so indecisive right now. It's really tough to get a better idea. So right here, we could look at that 200-day weekly and see we had a little touch here. We kind of rose it up, and now we're in this little place here, and we're above it now, right? So I'd expect possibly some touches along this line here too. So a good entry point if you're looking to get into gold, which is probably never a bad. The thing is, you don't want to just wait too long and not get in, but you can always layer in, right? So if you had X amount of dollars you wanted to buy, you could always buy a little bit every so often, dollar cost average into this, because you never know how far it's going to go up. But I'd expect it to retrace back down a little bit, because we're not just completely driving up, and since we have such a high market cap, it's going to be tough for this just to exponentially leave us, right? So I'd expect some good entry points, let's say around this 200 weekly average. That's probably a good place to add some positions into gold, and also the 200-day moving average is also some decent ones here. So it's a little bit less, it's a little bit more immediate, but you could say if you can get prices around $1,500 an ounce, you might as well try to, right? Especially if you're entering in with larger amounts versus, let's say, just paying top price right here. So two different entry strategies here, and I wouldn't be selling your gold, man. You know, if you got gold, hide it away. Don't tell anyone about it. Rainy days could be coming. All right. So that's this gold itself. That's some different things about different assets in relationship to gold. Now, there's all these other darn gold assets that I've been asked to look at. So doing that, I wanted to go over like just a general framework of what we're looking at. So let's just say we pull out GLD. And it looks pretty similar to gold. You know, we could say that it is somewhat, in a technical sense, it's forming a cup and handle here as well, which is, or a bigger one, which is kind of a sign that, you know, are we having this bigger market cycle transpire? That's kind of interesting to look at. And this is almost identical to gold, this one right here. It is, like, you could see this one, it's almost mirroring it, just like 10 and a factor of 10 less. I imagine that this has to be based off of bullion itself. So let's just look that up really quick. So yeah, I'm not really sure with this one. Sorry that this is all over the place. This is gonna be a long video. I mean, my bad. Gold Shares is the largest physically backed gold exchange traded fund, ETF, in the world. So it's physically backed, which would make perfect sense because it's mirroring the price of gold. So in this broader sense, we could say that this ETF, we could say right here, this one is going to mirror, let's say, the price of gold a little bit more than maybe a typical one. Come on. And that's just making me interested. So this one is basically like almost like buying the gold itself, in the sense that you don't have the physical asset. It's just mirrored to that price. So it might be a good way to, you know, buy and sell gold without having to get your hands physically on it. Let's just look at mine here, because so here you could say that this one is it's kind of similar. It had this rise up, and it's a much deeper depression. But is that just in the, you know, maybe it's not. It's thinking about half its value loss. So all right, I'll have to look at that horizon and see what the hell is it backed on. But yeah, that's something to be aware of, that potentially now you can see how this is really beneficial for me too, because now I'm becoming more aware of, let's say, my exposure in gold might not be as what I want it to be. I mean, I might be in an ETF that's more based in a mining and streaming company. So you can see the knowledge here, but the same thing here is that I'd have to admit that we still have a quite bullish setup right here. We're still in this large, kind of a cup formation. So I'm not really too worried about HUG right now, but I'm gonna have to do some work behind the curtains here and see what the heck I'm actually looking at. Let me just take a quick you know what, I think that's what I'm gonna do for this one. I covered a lot, so we're just gonna call this a video, okay? And I'm gonna be making another one today, and I think it's gonna be a little bit better because I won't be so congested and I won't be fumbling over my words. Awesome. All right, bye-bye.